Thank you guys for joining. I'm Mark LaMonica. We're going to talk about international investing opportunities. So we'll go through some ETFs and some shares, get any questions from you guys. But first, anything you hear today is general advice. I don't know anything about you, so of course I can't offer personal advice, but I still would like questions. So you can come up with harder questions than the ASA folks, which is a challenge that probably won't work well for me. All right, so we're going to talk, and we talked last week around the reasons you want to invest internationally. So of course, those reasons are, number one, we do want to diversify our portfolios. We want to get exposure to different companies and sectors that may not be prevalent in the Australian market. And we want to make sure that we don't have too much exposure to local economic conditions. Now we're going to look at some opportunities, which is good. So a couple things. One thing that we did talk about last week, of course, is relative valuation and where opportunities are in the world. So what I did is I took every country where Australia covers individual where Morningstar covers individual shares, and looked at the price to fair value. Now, as a reminder, the price to fair value is what our analysts believe a company is worth. The price, of course, is what it's trading for. So a price to fair value below 1 indicates that our analysts think a share, and in this case, an aggregation of shares rolled up at the country level, is undervalued. Anything that equals 1, we think is fairly valued. We think the overall price versus the value is the same. And anything over 1 is something that we think is overvalued. So, as I said, I took every country where our analysts cover individual shares, we rolled them up and aggregated them on the country level, and here they are. And I just wanted to illustrate this just by showing that you can have very different valuation levels in different countries. And so one reason, of course, invest internationally is that maybe if the opportunities are not great in the country you live in, you could find better opportunities somewhere else. So as you can see, we go from the lowest price country that we cover right now, which is China, to the highest price country, which is still 1% undervalued, which is New Zealand. And then, of course, we can see we've got Australia right here, pretty close to the bottom. And I won't spend too much time going on here, but I think it just was an interesting snapshot. And also an interesting snapshot when we go back and we look at where we were a year ago, and we can see what are the changes. So of course, those valuations can change over the course of the year. And obviously the prices will change as well. So China is an interesting one. The one thing I would say about China, and I will say in the last podcast episode we put out on Sunday, which was with Matt Wacha, who is our Chief Investment Officer for Morningstar in Asia Pacific. One of the areas that he said he's really seeing value is China, particularly around some of these Chinese technology names. But I thought China would be a good illustrator of some of the things we need to think about when investing overseas. So China is obviously somewhat controversial from an investment standpoint, and I guess other standpoints as well. But we'll talk about investing today. And many people do not like investing in China. I will put myself on that list. I would not invest directly in a Chinese equity. And really what that is with any overseas investments, we need to think about the rule of law in those countries. We need to think about investor protection in those countries. And really a lot of these opportunities that we've seen, particularly around these Chinese tech shares, is around, of course, government intervention in those markets. And we particularly saw that around some of the large Chinese tech shares. So it is something to consider anytime you're investing somewhere. The one other thing that I think China illustrates really well, and I don't have the data in front of me on this, but the Chinese equity markets have not performed that well if we go back and look over the long term, which is interesting because the Chinese economy has performed very well. If we look at overall GDP growth, we've seen a lot of growth in China. But a lot of that hasn't translated necessarily into returns for investors. And it is important to remember that, of course, economic growth does not have a one-to-one relationship or anywhere close to a one-to-one relationship with investment returns. And if we go back, interestingly enough, if we go back and we look in the US and we look over the past 20 years or so, US economic growth has kind of continued to slow. But investment returns have been very strong. So when we think of the overall economic pie, we have to think about who is getting that overall economy and the economic growth. And it's not necessarily shareholders. So we really think about there's the government, there's of course employees, and then there's the owners of companies, so shareholders. So just something to think about. In the US, with a lot of the widening inequality, and I don't think anyone thinks that that was a good outcome, but really a lot of what's happened is more profits have flowed to companies. Less profits have gone to workers. Certainly less has gone to the government as taxes has been cut. And so just something important to think about. I think a lot of investors reflexively look at overall economic growth. And certainly what we're looking at is an acceleration. And I'm not contradicting, of course, what our CIO said, so you shouldn't listen to me. But just think about, as an investor, sort of where you want to put your money and what are some of the different risks associated. And there's certainly a lot of geopolitical risk in a lot of different countries. So anyway, something to think about. Now we can move on, and I won't talk about China anymore, although Lisa said something about China. Personally, the Chinese new economy ETF performed extremely poorly for me, and I was forced to sell at a loss. But it appeared to be affected by the political standoff between Australia and China during the period. It's a good point. Thank you for sharing your personal story. We do have a question from Adele saying, what about South America? So South America, interestingly enough, was another place that was mentioned by Matt Wacha, particularly Brazil. And he was talking about where he saw some strong opportunities in Brazil, particularly around miners and banks. And Matt actually said that he thought, not that they did not own any Aussie miners and banks, but he thought it was a better opportunity with Brazilian miners and banks. So just something that's interesting. Of course, it's pretty difficult to access direct Brazilian equities, but I'd say South America overall, it's the same lesson for everything else. I think it's thinking about some of the different risks associated with investing in each one of those countries. So obviously, we have seen a history of issues in terms of government defaults, mostly Argentina, but some other countries as well. We have seen issues related to that. And of course, we have to think of that political environment, how that's going to influence any of those investments. And this is just the risk associated with investing in any country. Now, I think one of the reasons why investors exhibit a lot of home bias is because, of course, generally people think things politically, well, I would say they understand things politically in their own country more so than in another country, but they also probably overemphasize the stability of a political system because you were just going about your day-to-day life and everything still seems fine until it's not. So anyway, some things to think about when you're investing overseas. We seem to have a lot of questions already. Okay, so we've got a question. What about Chinese shares? The example is Trip.com that are also listed in the US. What price to fair value ratio is applicable, China or US for the US listing? So I would have to double check this. My guess is it goes into both. So my guessing is a rating on the Chinese related share would go into China. Cross-listing in the US, the ADR would go into the US, but I need to check on that. George says, I fear that a re-elected President Trump will ruin the US economy and potentially everything else. How do I hedge that? Yeah, that's a tricky one. A Trump hedge. I'll have to think about that. I mean, at the end of the day, The simple way to hedge that, it would be reducing exposure to the US if you think that that's likely to happen. So both his election and then, of course, him ruining the economy. And if that is your view, and if that is a very strongly held view, makes it challenging investing overseas because so much of global indexes are made up in the US. You don't have to apologize, George, by the way, for saying something about Trump. We've got some ETFs. We'll get to ETFs, Jeff. And that other question about South America and cross-listed stocks in the US, let me try to figure that out. I just don't want to give the wrong answer, although I gave one, so who knows. All right, so we're going to talk about some investment opportunities. So we'll start with ETFs. And I went in and I looked at all of our gold and silver rated global ETFs. So of course, our manager research team goes out there and rates ETFs, gold, silver, bronze, neutral, negative. Gold, silver, bronze are ETFs that they believe will either, if they're a passive ETF, that they're a really good opportunity to get exposure to that country and capture that index return, or if they're an active ETF, same thing with funds, that they think they will outperform their peer group. So I skipped all the bronze, basically because there was a lot of them and I didn't want to fit them onto the page. And we'll talk about a couple of these specific ETFs, but I did want to give the list, go through a couple different types of ETFs we have on here. So I say we really have 3 different ETFs, and in many cases, 3 different types of ETFs. So we have broad indexes. So anyone who attended during the ETF sessions understands that, of course, a broad index is something that is covering, even if it's a single country, a large cross-section of the equity market in that country, or potentially just a global one covering lots of different countries. So you can see on here, we've got a lot of the broad ETFs. So of course, all of these Vanguard products. So first one, S&P 500. Then we've got MSCI Developed Market Index. We've got a hedged version and an unhedged version here. Small caps globally, S&P 500, S&P 500, hedged and non-hedged. So we have those broad-based ETFs. The other thing that's on here a lot is a factor ETF. So factor ETFs are basically, the premise behind this is that going back and looking historically, there have been certain factors or attributes to a share. Very simple one is income that we talked about last month. There are certain attributes to shares that in the past have caused or have led to outcomes that we want from a portfolio perspective. So that outcome could be lower volatility. It could be higher returns than the index. Could be a combination of both. So factor ETFs are also on this list a fair amount. So we've got this VanEck Quality ETF, which I know is in one of the questions. We've got the World Multi-Factor ETF, which we'll talk about in some more detail from BlackRock iShares. We've got World Quality Mix. So lots of quality, and here's a hedged version of that VanEck Qual. So lots of factor ETFs. And of course, we've got a couple ESG related ETFs. We've got this one from State Street. So carbon control, that's what that CB control stand for. That's the hedged version. That's the carbon control non-hedged version. And we've got Vanguard Ethically Conscious International Shares. So 3 different types of ETFs on here. We'll spend a little bit of time going through a couple examples, but these are the ETFs that our analysts like the most. And there's a longer list that includes all the bronze ones as well. That is a very good point. I think I did put on. Okay, Roddy's making a very good point. I think I did put on one ETF that is not domiciled in Australia, which, yes, let me go back and check those. So yes, I might have made a bit of a mistake with that one, but let me go back and check the list. So sorry about that. Thank you for pointing that out, Rodney. But let's look at one of these ETFs. And really the idea behind this is to kind of go through the process that you might go through if you're evaluating ETF. So of course, it is always nice when you do have access to our analyst report. I took a little bit of it, but just really want to talk through some of the things you want to think about. And one of the first things you want to think about is, of course, the process. And the process is what an analyst goes through, or what an ETF provider goes through in terms of selecting the securities that go in there. So really, if we're just tracking one of those broad-based indexes, then we're going to, of course, just track that broad-based index. If we are going out there and have an active process, we can look at what that manager is actually going through in terms of selecting the securities that go in there. But with a lot of these factor ETFs, what we want to look at is, of course, how that portfolio is constructed and designed. And so if we look at this multi-factor ETF, we can look at, once again, we know what we do know what a factor is now, because we talked about that. We can see this one, there are 4 distinct factors that go into this portfolio. So what are those? Well, they're looking at quality. We'll talk about quality in a second. Value, so they're looking at cheaper shares. Momentum is, of course, looking at that share price performance over time, that there's a theory that momentum keeps up. And smaller size. So we're looking at little companies there. So all of these factors, and as it says in this overview, all of these factors have exhibited strong performance in the past. And you can see here that some of this academic research that has looked at that. So then kind of the next thing that I always look at is, well, we're looking at international investing here, right? So we need to start looking at some of the different countries that it's exposed to. You could also take a sector view of this, but there wasn't anything that really jumped off the page from a sector perspective, but all this is available on our website. So for a country, once again, and this goes back to that Trump question, almost every global ETF or fund that you are looking at is going to allocate a lot to the United States. And that is because the US, of course, makes up a large part of global markets. So you can see big allocations. So maybe if you're worried about Trump and Trump ruining the US economy and whatever else he wants to ruin, you would be a little bit concerned about that. But just always good to sit there and look at the exposure, especially when we've talked about this in the past, because a lot of these ETFs are marketed as being global, but they're really dominated by the US. The other thing I want to look at here is and I could have put a couple different charts out there, but just because of these different factors that are involved, I didn't want to sit there and look at, okay, well, how does this ETF actually deliver what it says it's delivering? And a lot of this is our analyst work. If you don't have access to our analyst report, something you can do on your own. So one of the factors in here, and I just use one as an example, one of the factors is value, of course. So from a value perspective, what we'd expect to see, and when we talk about value, what we'd expect to see is that in the traditional measures of value, that this is going to be cheaper than the overall index or the overall category. So this certainly fits the bill. We can see a price to earnings ratio below the index, below the category. Same thing for price to book, price to sales, price to cash flow. So at least in that one basis, I think that this does capture what it's supposed to be saying. And so what I would do, obviously, going back and looking through those different factors, is go back and look at different ways to explore that through the data that's in there. Because, of course, there's no point in buying an ETF, particularly a factor ETF, if you're not actually getting exposure to that factor. So that was a very quick overview. But if there are other ones that people want me to do, throw them in the chat and I can go to the website. Hope I'm not on an inappropriate website when I click into my browser, but yeah, I can go there and do the same thing. The other, is that the exact same one? Okay, I did not update the name because I'm an idiot, apparently. But the other one I wanted to look at, that Vanguard MSCI Index International Shares ETF. So you'll remember that is this guy, VGS. Sort of looking at that. There's also that hedged version, and see what our analysts say about this. So, of course, in this case, what we are looking at is a broad index. And you can see it in here that it covers 22 countries, approximately 1,500 holdings. But once again, we should be aware, heavily weighted towards the US. So something to consider. But really reading through this, what we want to look at, of course, is how do we want to get exposure internationally? And in terms of how to get exposure, we're talking about different approaches, whether you're buying individual shares, which we'll talk about in a second, or if you're going out there and using a manager, do we want to take an active and passive approach? And our analysts, generally an analyst speak, will talk about if they think this is a good way to get exposure. So in this case, and once again, this is just analyst talk at its best, we expect the strategy to deliver long-term peer relative alpha. Well, there we go. Thereby strengthening our conviction, the strategy is an excellent choice for gaining global equities exposure. Okay, so that is, hopefully none of them are watching this, a terrible sentence that they could have made a lot more clear. What are they trying to say? What's alpha? So alpha is outperformance. So basically, market goes up 10%. Anything we generate on top of that is alpha. So you'll hear that thrown around. It's a little bit of a strange finance term. So what are they saying? Long-term peer relative alpha. So what they're saying is that within the global equity category, they think this is going to do better than its peers. So what they're actually saying is they think passive will do better than active. And they say it down here as well, also in, say, not very friendly writing style. However, in terms of long-term performance, Vanguard edges past most managers in the cohort. In summary, for an increasingly efficient global equity market, the ETF is an outstanding choice. Blah, blah, blah. So what does increasingly efficient mean? What it basically means is the more efficient a market is, the less likely it is for somebody to outperform. So what they're saying in all of this analyst speak is they're saying they think passive investing over a large cap global developed market, in the large cap global developed market space, is the approach that you should actually take. So yeah, just thought we'd do a little analyst speak there. And then, of course, when we're talking about sectors, and this is what we touched on last week, we, of course, as Australians, want to get exposure to other sectors that are not necessarily in the local market. Namely, there's not a lot of technology locally, so you're certainly getting that. So we want to compare that to kind of what we're exposed to in the Aussie market, which is a lot of basic materials and a lot of financial services as well. So something else to think about if you're investing internationally for those specific reasons. All right, I'm going to pause for a second. We have some questions, mostly about how I might have screwed up that that initial. Yep. Okay. Well, thank you, Rodney, as always, in the questions. So Rodney's just pointing out in BTS, it is available on the ATS, but it's US domiciled, so there could be some unfavorable tax consequences. So thank you for pointing that out, Rodney. I should have been more careful. The anonymous attendee, who's always our favorite attendee, most of these ETFs are heavily weighted to the US, considering the shape of the US economy. Isn't it a better idea to be in emerging markets? Really good question. So let's talk about that for a second. Let's talk about emerging markets. So there has been a lot of talk about emerging markets, which is good. What are emerging markets? So emerging markets are really just the fact that we divided up the universe of countries out there into developed markets and emerging markets. Now, this was done a while ago, and it is now kind of ingrained in the way that we think about investing. But what I would say is there are a wide variety of emerging markets that fall into that bucket. We have countries that look very much like developed markets. So particularly if we look at Taiwan, South Korea, China, all countries that are developing markets. Then we have markets that are more developing. Israel's in there. So any sense, particularly kind of South Korea and Israel and Taiwan, if we go and we look at things like GDP per capita and things like that, they look a lot like developed markets. And then we have markets that are certainly less developed. And so all I would say is, like, when we're looking at a giant category like emerging markets, it is difficult to make generalizations because we're looking at so many different countries. Now, remember, the question about how much is allocated to the US, if we go look at developed markets, a lot of it's allocated to China. So just something to remember as well if we're looking at emerging markets. The other thing that I'd say is, you have the comment in there, considering the shape of the US economy, isn't it a better idea to be in emerging markets? Well, I think that we do need to, once again, as we talked about earlier, kind of separate economic, and the economy plays a role, but separate sort of the way that we measure an economy from companies that are based in that country. So there are certainly, in the US and every other country, not every other country, a lot of other countries, there are giant multinational companies whose fortunes are not necessarily based on the country that they're actually listed in. And our analyst actually says it right here, interestingly enough. So if we look at this VTX, the index is skewed towards the United States, but given the majority of its holdings are multinationals earning sizable revenue from international markets, concentration is not a notable risk here. So basically what our analyst is saying is no, the US economy is not that big of a risk because these are all giant multinational companies. So like everything else, there's a lot of different considerations that you need to think about as an investor. But as I said with China, I wouldn't reflexively think that strong economic growth is necessarily going to translate, depending upon the economic system in a country, translate into really good share returns. There's a lot of other factors involved, a lot of other factors where the companies are actually getting their revenue. Of course, the rule of law in those countries and protection for shareholders. And simply remember, an economy is made up of a lot more than just publicly traded companies, right? We certainly got more and more companies that are private. We certainly have state-owned businesses. There's all sorts of different stuff to put in there. So yeah, I think there's certainly, concern. There is certainly concern about the U.S. economy and what's going on, but just remember that that's not necessarily going to be the only driver of returns. All right, so we're going to move on to some stock ideas. Now, I will say that you're just going to have to listen to the ones that I picked, but we do put out a report every month. If anyone would like a copy of it, I will send you the report for April if you send me an email, and it's called Morningstar Global Equity Best Ideas. So basically, we take all of our analysts all over the world. They cover 1,600 stocks in all those countries that I put out there on that initial page. And every month they came up with, guess what, their best ideas. And so we do publish that report in the first of every month. And it's supposed to be just that. It's supposed to really just go in there and look at what their best ideas are at that point in time. And then, of course, you can read and research a whole of those companies. So there are 81 of them on the list for April. And of course, I don't have time to go through 81 of them, and nobody would want to sit through that, especially since you can read it yourself. So what I did pick is I picked 3 different shares for us to go through. I have different rationale for each one of these, but just remember, this is not telling you to go out and buy the shares. It is just an example to talk about, to talk a little bit about our research. So things that I thought were interesting. So anytime we look at a share at a high level, what we're looking at is the different data and ratings that are actually provided by our analysts. So because the table of contents isn't on there, industrial, so this refers to the sector. And yes, industrial is a little weird when we start talking about the company that's classified in there, but it's classified in there. the country it's trading. I did pick 3 shares from the US, and I only did that because it's the easiest market to access to buy direct equities. But yeah, maybe some people might agree with that. Star rating. So what does this star rating represent? Star rating represents where this is from a price to fair value perspective, sort of where the share falls. The moat, wide moat. This is uncertainty. So that is the uncertainty that our analysts have over their estimation of future cash flows. So remember, any analyst is trying to predict the future. That's pretty hard because none of us know what's going to happen. But some companies, they have a lot more certainty about based on the different risks that are facing that company, based on the business model of that company. So in this case, we have very high uncertainty. And what we want from a high uncertainty standpoint is we want to build in a bigger margin of safety. And that's the difference between what you would purchase something for and then what it is actually trading at. And this is the price to fair value, 0.62. So our analysts believe that it is 38% undervalued. So we'll talk about the company Equifax in a second, but basically what we get in each one of these global best ideas is we get a small summary. And then, of course, if you click that view company profile, you can go read the whole research report. So anyone who requests this thing, I'll, of course, send it to you in a PDF, and you can see that little summary for every single share that's in there. But then the overall research report provides more information. All right, so anytime that you generally see a company that has a big discount to fair value, it's because something has gone wrong, or our analysts don't think the market's appreciating what the company's actually doing. But you generally won't see a company that everyone thinks is doing fantastic with a huge discount between price to fair value. So I'll start all of these by just saying what the company has actually done wrong in the eyes of investors, and really what we want to, you made Emily laugh, Lisa, with your latest comment. What we want to do as investors is we want to assess if this problem is temporary and represents a good investment opportunity, or if this is going to be a long-standing problem. And frankly, the market's right. So what's going on with Equifax? Well, number one, big data breach in 2017, something that I think we all know about in Australia, that there are certainly issues with cybersecurity. So huge data breach, and of course, a very problematic set of data because these companies, these credit rating bureaus in the US, of course, keep your credit score, your social security number, all sorts of different stuff in the US. So 2017 was obviously a long time ago. Our analyst seems to think that this is mainly behind them, but there's still some ongoing legal and product liability costs. And then the other thing is around sort of the business. So Equifax is known mostly as being a credit rating agency. So just like in Australia, you have a credit score that's going to impact the loans that you can get, and of course, what interest rates you're going to pay. But they also do a couple other things. One of their largest divisions is they do have basically a workplace employee background check for new employees. So you hire somebody new, they go back and they look at your background. So in the US, to get a job, you need a background check. To buy a gun, no problem. We'll just give those out in the street. That's just my little aside. And really what people are worried about is two different things. So they're worried, number one, that a lot of the credit check scores that, of course, are run on people, they are run when they go out there and they get loans. It's a requirement to run a credit check score when someone goes out and gets loans. And then, of course, when do you go out there and run an employee history check? Well, you do it when you hire somebody. So there are a lot of concerns about, as we've been talking on here, around the general economic conditions in the US. So of course, if companies stop hiring people, you're going to see a drop in those employment verification checks. If people stop going out and getting loans, you're going to see a big drop in those credit score checks. So those are really the concerns. So as I said, anytime you're buying a company, first thing you need to do, particularly if it hasn't performed that well, is figure out what those concerns are. Why has it gone down? What is the market worried about? And then as an investor, you need to figure out, okay, are these legitimate concerns? Are these concerns temporary? Are these concerns being dramatically overestimated by investors? So investing is nothing else but a risk and return trade-off. So really what you would do here then is go in and look at, okay, what could be the impact of different economic conditions and how would that impact this company? And that's of course what our analysts try to do in their research report. So in our analysts' opinion, these concerns that investors have, that the market has over this company is, of course, overblown and believes it actually does represent a good long-term value. So there's our first example. And, I will say a couple other things, wide moat. So obviously important. You can go read what our analyst thinks about why they think it's a moat. So basically intangible assets is why they think it has a strong moat. And a lot of that has to do with, as we said, like this employment verification service where there are no competitors, no meaningful competitors, makes up about 45% of the revenue and 57%, I have this written down, I did not remember this, 57% of the overall earnings. And just the fact that there is no competitor there. And actually the analyst did put in the risk section, one of the reasons why it's high risk is because there's worried about antitrust because of that. And then of course, the US really has 3 credit rating agencies. And actually all 3 credit rating agencies need to be checked legally every time you go out and get a loan. So that's a pretty good place to be in from a market perspective. So that represents an intangible asset. So an asset the company has that does not sit on the balance sheet. All right, let's move on to our next company. This is a good one. International Flavors and Fragrances. All right, so what do? At the end of the day, they go out there and they create, as I said, flavors and fragrances. They have 4 different segments. So they have flavors and fragrances, so flavors on this side of things that go into food. So this may shock you, but a lot of the packaged food that we get is not baked by some grandmother and then put into a package. There's a lot of stuff that goes in there that is certainly enhancing, whether it's shelf life, enhancing taste, making you eat 500 of them because they put so much salt in it or salt flavor in it that you can't stop. So there are a lot of things that go into the food we eat. They supply that. They also have a health and biosciences side. They make enzymes and cultures, which is interesting. They have scent segment. So we all like to smell good. We put scent in all sorts of different things. Not just talking about Chanel No. 5 now, but obviously a lot of different products that we use do have a scent in there. And then where's the last one? How did I lose this one? Oh, personal care. So they have personal care as well. Oh, sorry, pharmaceuticals is the last one. So they do create inputs into pharmaceuticals. Now, what's going wrong with this one? So we see this one as being 32% undervalued. Now you'll see that this is actually 5-star because our uncertainty rating is medium. So we need a smaller margin of safety. So in this case, it's 5-star. Once again, a wide moat. So what's going on with them? Why are they so undervalued? Well, they bought DuPont's, a big division of DuPont back in 2021, Danesco Industrial Enzymes and Cultures business. So they went out and bought that and took out a ton of debt to buy it. So there's certainly investor concern around the level of debt. And there's also a fair amount of skepticism that they'll be able to grow as fast as management says they'll be able to grow. So remember, as investors, we want to look at expectations. Now, in this case, management's expectation is higher than what the market is for it, and kind of figure out, okay, well, who do I agree with more, management or the market? And so, that's certainly a case where it's impacted this share price. But once again, wide moat from 2 different sources. One is intangible assets. So once again, it is just the fact that within the industry, they do have a good brand in terms of all the inputs. Wouldn't be anything you and I would see, of course, but it would be the actual companies that are buying their products. And the other thing is switching costs. So of course, when they get themselves embedded into the supply chain and the manufacturing process of all of their customers, we believe it's very costly and difficult for any of these companies to switch them out for a competitor. So that's really where that wide moat comes from. All right. Our last one I picked for two reasons. Number one, I picked it because it has it's the second cheapest stock in terms of price to fair value in our Global Best Ideas report. It is trading for 0.24. So what does that mean? That means it's 36% undervalued. Sorry, I cannot speak today. It is 76% undervalued, which is a lot. So I picked it for that reason. And I also picked it because HanesBrands has a pretty significant Australian business. They own bonds. So overall, I don't remember what our little term is. They make a lot of underwear and all sorts of different brands. Hanes is one of the main brands in the US, but Bonds in Australia. And really what has gone on with this company is they have had huge problems around inventory going into inflation. We've seen a lot going into COVID and coming out of COVID. We've had huge problems where companies basically have not reacted well to changing consumer habits and carried way too much inventory, which has been a big problem for them. And they're having a fair amount of problems with inflation. So basically they're having problems associated with passing on the, wow, Lisa, you're on a roll today. Buying Hanes would be handy just in case you lose your shirt in the market. They're having huge problems with it passing on that the higher costs that they've had as a company to consumers. Apparently people do not want to spend more on underwear. So this is certainly very much a turnaround play. So this would be a play if you believe, once again, that these problems that they're going through will clear. They'll clear these inventory problems. They'll be able to deal with inflation and eventually be able to pass that along to consumers. But yeah, once again, narrow moat. And we really think the narrow moat is around brand. So Champion, I don't know how big Champion is in Australia, but it is a fairly big brand in the US. Certainly Hanes, Bonds is an example. So we do certainly think that there is a benefit to holding all of those brands, but we think there's some problems that they need to turn around. So this is very much a turnaround play. All right, we've got some questions and a lot of comments, mostly from Rodney. All right, so Lisa says, I find IFF fascinating, wonder how they are now navigating their way into a more sustainable natural market base that is emerging due to climate change. Well, that's an interesting question. I don't remember, I did see something in the report around ESG. So it's certainly something our analysts are looking at, but I don't believe that they actually identify that as a material risk. But that is a really good question. We should always look at how these ESG factors and how changing consumer views are going to drive things. Let's see if they have anything. Yes. As a chemical producer, here we go, Lisa. As a chemical producer, IFF faces some ESG-related risks associated with the environmental impact of its products. Regulatory changes may be the most considerable ESG risk. For example, regulators could require more formula disclosure, reducing their competitive advantage from their proprietary formulations. Well, there we go, Lisa. Good comment. Now, of course, I have lost the Zoom. So we have mostly comments around Yeah, we have mostly comments that Rodney's answered. So this is too easy. This would have been a good day for you to do the webinar, Rodney, so that I wouldn't have to do them back to back. Yeah, so Jeffrey has a really good question. Can you talk about the performance of the Morningstar Gold rated ETFs? I can send that to you. It's actually very strong. And we've just gotten some data, but I don't remember them off the top of my head. But if you do send me an email, I can get that to you, Jeffrey. And so thank you for that. And maybe what I'll do is tonight, if anyone tunes in tonight, my third webinar of the day, then I can share some of that. But that's a really good comment. I should share that stuff more because it actually makes us look good, which is always nice. All right, we seem to be out of questions, which is good. Well, anyway, thank you for joining today. If you do want that global equity best ideas, just shoot me an email and I'll get that to you. If anyone wants to double dip, I'll be doing more of a summary. So we'll cover some of the stuff we covered today, and it'll also cover what we covered last week in the nighttime webinar, if anyone's interested. So anyway, thank you guys very much for joining. I appreciate it.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.